When the markets are bleeding red and market crash is the only thing on the news, what's your gut reaction? It's to panic, right? Most investors just dump everything and run for the hills, locking in some truly devastating losses. But what if I told you that the fear you're feeling, this massive, widespread panic, is actually the single greatest wealth-building opportunity you might see for years? Welcome to Generational Wealth, your pathway from knowledge to legacy. I'm Edmund. Quick disclaimer, I'm not a licensed financial advisor. This is for educational purposes only. Crypto is volatile. Never invest more than you can afford to lose. Do your own research. History shows that moments like these don't destroy wealth for everyone. For the few who know the playbook, they create it. In this video, I'm going to pull back the curtain on the exact strategies those traders use to turn fear into a fortune. We're going to cover the psychology, the practical steps, and even some advanced moves the pros use when everyone else is selling. Stick with me, because what you learn today could honestly change your financial future. So before we jump into solutions, we have to understand the real problem. And spoiler alert, the problem isn't the market falling, that's just part of the economic cycle. The real problem is how we react to it. We are hardwired for survival. When we see a threat, like our life savings seemingly vanishing, our primal brain hijacks the system. This triggers a powerful fight-or-flight response, which in the investing world has a simple name: panic selling. It's a classic behavioral finance trap where investors frantically sell off assets because of fear and uncertainty. It feels like the right move. It feels like you're taking back control, stopping the bleeding. But what you're really doing is turning a temporary loss on paper into a permanent, real-life loss. Think about it this way. The stocks you own are pieces of actual businesses. If you owned a fantastic, profitable rental property, would you sell it for half price just because your neighbors were freaking out about the housing market? Of course not. Yet millions of investors do exactly that with their stocks. This is fueled by a sneaky psychological bias called loss aversion, where the pain of losing feels about twice as strong as the pleasure of an equal gain. This fear gets amplified by herd mentality. When we see a stampede of people selling, our brain screams at us to join the crowd, assuming they must know something we don't. But here's the secret. The crowd is almost always wrong at the market's biggest turning points. Following them off the cliff is the fastest way to wreck your portfolio. The data doesn't lie. Investors who panic sell almost always do worse than the market. Studies have shown that missing just the 10 best days in the market over a few decades can slash your total returns by more than half. And guess when those best days tend to show up? Right after the absolute worst days. By selling, you not only lock in your losses, you basically guarantee you'll miss the powerful rebound that historically follows. So if running for the hills is the wrong play, what's the right one? It all starts with a complete change in perspective. This brings us to our first and most important strategy: adopting the Warren Buffett mindset. Buffett, arguably the most successful investor ever, built his empire on a simple rule. It's his most famous quote: "Be fearful when others are greedy, and greedy when others are fearful." This isn't just a snappy one-liner. It's a complete operating system for how to invest. He's saying that the absolute best time to buy is when pessimism is peaking, when fear is everywhere, and when everyone else is desperately selling. In the eyes of a pro, a market crash isn't a disaster, it's a sale. It's a Black Friday event for top-quality assets. Picture your favorite company. Let's say its stock is trading at $200 a share, and you think that's a fair price. Then a market-wide panic hits, and suddenly that same great company is trading for $120. Nothing about the business itself has changed. It still has the same great products, the same smart leadership, and the same future ahead. The only thing that changed is the market's mood. The emotional investor sees a 40% drop and hits the panic button. The rational Buffett-style investor sees a 40% discount on a wonderful business and starts buying. This is the absolute core of turning fear into fortune. You have to mentally reframe a crash from something to fear into an opportunity to pounce. This takes discipline. It means you have to fight every single instinct in your body. But history has proven over and over again that investors who buy during downturns are the ones who build incredible wealth. Think about it. The stock market has recovered from every single crash in its history. From the Great Depression to the dot-com bubble, the 2008 financial crisis, the 2020 COVID crash, and even the crash in 2025 that saw a swift recovery by June, the market always comes back to set new highs. Your job isn't to perfectly time the bottom. Your job is to have the guts to act when everyone else is frozen in fear. Okay, so we get it. Be greedy when others are fearful. But that brings up a pretty scary question. When, exactly, do you buy? If you buy today, couldn't the market drop another 20% tomorrow? Look, trying to perfectly time the bottom is a fool's game. Not even the pros can pull it off consistently. This is where our second strategy, dollar cost averaging, or DCA, becomes your best friend. DCA is just investing a fixed amount of money on a regular schedule, no matter what the market is doing. For instance, you decide you're going to put $500 into an S&P 500 index fund on the first of every single month. This simple automated system is your secret weapon against fear and the anxiety of trying to time things perfectly. Here's why it's a powerhouse during a downturn. When the market falls, your fixed $500 automatically buys you more shares at a lower price. If the fund is $50 a share, you get 10 shares. If it tanks to $25 next month, that same $500 now snags you 20 shares. You are systematically buying more when things are cheap. When the market eventually turns around, you own way more shares that you bought at a bargain, which can seriously juice your returns. This strategy does two amazing things for your mindset. First, it takes emotion out of the driver's seat. The decision is already made. It happens automatically, so you're not up at night wondering if now is the right time to pull the trigger. Second, it actually makes you want the market to go down in the short term. It flips fear into excitement. A red day is no longer a reason to panic, it's a chance to load up on more shares at a discount. If you are a long-term investor building a retirement portfolio, DCA is the most effective and least stressful way to navigate a crash and come out richer on the other side. Before we get into the more advanced stuff for active traders, I'm curious. What's your go-to move when your portfolio is a sea of red? Are you a die-hard DCA fan? Do you stick to your plan no matter what? Or do you have another trick up your sleeve? Drop it in the comments below. Sharing what works helps all of us become smarter investors. And hey, if you're getting some value out of this, do me a favor and hit that like button so more people can see it. The first two strategies are perfect for a long-term set-it-and-forget-it investor. But what if you already have a big portfolio you need to protect? Or maybe you're a more active trader who wants to profit from the chaos itself? This is where we get into the pro-level playbook. Our third strategy is all about playing defense, hedging and rotating to safe havens. Think of hedging as buying insurance for your portfolio. If you own a ton of stocks, you can basically make a side bet that the market will go down. If you're right, the profit from your hedge can help cancel out some of the losses from your stocks. A common way to do this is by shorting a market index like the S&P 500 using tools like CFDs or futures. This lets you protect your long-term investments without having to sell them and cause a tax headache or miss out on dividends. At the same time, pros will often move some of their money into what are called safe haven assets. These are things that tend to hold their value or even go up when the economy gets shaky. The classic example is gold. When investors panic, they often flee from stocks to the perceived safety of gold, which drives its price up. Active traders can ride this wave by buying gold or gold-related funds. Another powerful safe haven is just plain old cash. Holding cash during a crash isn't a sign of defeat, it's a brilliant strategic move. Cash keeps you safe, but more importantly, it gives you dry powder. That's the ammunition you need to go on offense and scoop up all those amazing assets that are on sale when you feel the time is right. All right, our final strategy is the most advanced. It comes with the highest risk, but it's also how some traders make their biggest wins during a crash. This is strategy 4, trading volatility itself. When the market panics, one thing is guaranteed to go through the roof: volatility. Volatility is just the measurement of how wild the price swings are. In calm markets, it's low. In a crash, it explodes, and you can actually trade it. The most famous gauge of market volatility is the VIX, nicknamed the Fear Index. When the VIX is low, markets are chill. When the VIX spikes, fear is off the charts. Traders can bet on where the VIX is headed using different financial products, like VIX-linked ETFs. For example, a trader who smells a sell-off coming might buy an ETF like VXX. If panic hits and the market dives, the VIX will likely shoot up, and the value of that ETF could soar, creating a massive profit. These tools let you place a direct bet on fear itself. Now, a huge word of caution: trading volatility is a razor-sharp, double-edged sword. These tools are complex and incredibly risky, and they often lose value over time when markets are calm. They are absolutely not for long-term investing. They are sophisticated instruments for experienced, short-term traders who know what they're doing and can handle big risks. For the right person, though, they represent the ultimate way to turn market fear directly into profit. So what's the game plan? When the market goes into a full-blown panic, the average person sells and locks in their losses. But you're not the average person anymore. Now, you have a playbook. First, you're going to adopt the Warren Buffett mindset, seeing a crash not as a crisis, but as a massive sale on incredible investments. Second, you'll use dollar-cost averaging to systematically buy more as prices drop, taking emotion and guesswork completely out of the picture. Third, if you're a more active investor, you'll use the pro's playbook, hedge your portfolio, and move to safe havens like gold to play both defense and offense. And finally, for the highly experienced traders, there's the option to trade volatility with tools tied to the VIX, making a direct bet on fear itself. The next time the headlines are screaming about a market crash and your gut tells you to run, I want you to remember this video. Remember that your own fear is the enemy, but widespread fear is your friend. These moments of panic are not to be feared, they are opportunities to be seized. With a clear plan and the discipline to follow it, you can shift from a position of fear to one of power and turn market chaos into your personal fortune. Thanks for watching. Don't forget to subscribe for more tips on how to build wealth and master the markets. Check out our website at generationalwealth.biz. We're always updating it. I'll see you in the next one.